And joining us now on the debate in Boston, Massachusetts, Marc Rowe, professor of corporate securities law at the Harvard Law School. In New York, New York, Marc Levinson, senior fellow for international business at the Council on Foreign Relations. Here in studio, Alan White, professor of finance at the Rotman School of Business. And once again, we welcome back from New York, New York, Henny Sender from the Financial Times. Alan, good to meet you. First time on the program. Good to have you here. And to our guests in the States, we thank you for joining us as well. We should just also say by way of introduction that this is a second part, if you like, in our look at the financial crisis and regulation emerging from it. 2 weeks ago, we took a look at the political influence on Wall Street. And if people want to check that program out, they can go to our website, tvo.org/theagenda, where that program still lives. And tonight, we will take a look at the specific plans for regulation that are swirling around Washington right now. And to get that discussion started, I want to read something that Neil Ferguson, your colleague from Harvard, and Ted Forstmann, founding partner of Forstmann Little & Company, on what they call the trilemma regulators face. Here we go. A trilemma is like a dilemma, only there are three things to choose from, and you can have just two. The current debate over post-crisis financial regulation suggests we face such a trilemma. We can choose any two of the following, but not all three. 1, efficient capital markets. 2, no bailouts to big banks. And 3, a depression-free economy. From the 1980s until 2007, we essentially opted for 1 and 2. Financial markets operated with more freedom than at any time since the 1930s, and the Federal Reserve stood ready to cut interest rates if asset prices tanked. But the idea that big banks might be able to get new capital from the Treasury was scarcely even contemplated. Choosing 1 and 2 resulted in a global financial and economic crisis worthy of the name depression. In the aftermath, congressional Democrats are claiming that we can have 3 out of 3. In effect, the bill introduced to the Senate by Christopher Dodd purports to prevent future depressions without sacrificing the efficiency of our financial markets or committing taxpayers to future bailouts of the banking system. This trifecta is not credible, say the authors of that piece that was in the Wall Street Journal last month. Okay, everybody, Marc Rowe, to you first. Let's go around the horn on this. Do you agree with the way they've laid the case out here that that is the choice facing American lawmakers tonight?
Maybe stated more dramatically than it needed to be stated, but essentially that's right. The two major reasons that people have put forward for why we got ourselves into this financial crisis are global imbalances and regulatory error. The global imbalances come from the fact that we've got a big trade deficit with China and other countries. We're buying a lot of oil. Cash comes back into the United States. We're very good at processing this cash, and that tends to create some bubbles. The regulatory errors of having regulated institutions that are too big to fail and end up taking too much risk are still going to be with us. We're going to correct some of the problems that we faced before, but we're going to still have this problem going forward. We just have to be alert to it and hope we catch it faster next time in the impending crisis of 2014.
You've already got the date set for when it's going to happen, eh?
Somewhere around there.
Somewhere around there. Okay, Marc Levinson, come on in here and tell me what you think about that trifecta argument.
I think at the moment we have a lot of denial going on when we discuss financial regulation. It is everyone's fantasy that somehow Congress can pass a law and that will put an end to the risk. That will put an end to the possibility of a large bank going bust. It will put an end to the possibility of a banking crisis. At the end of the day, financial regulation is done by individuals, by regulators. And there's no way that simply by passing a law, we can resolve that fact. If you have people in regulatory positions who don't want to regulate, which has been the case in this country until recently, then you're going to have future financial crises. If you have critical situations, such as, for example, extreme weakness in a very large bank, the powers that be will have to deal with that regardless of what's in the law. So the idea that all of this stuff can somehow be written into law and we will be protected forevermore is just not on.
Just not on, says Marc Levinson. Alan White, what do you say about this trilemma?
I agree with Marc. I think it is the willingness to regulate that is a serious problem here. And the whole U.S. political system is bifurcated by the need for the politicians to satisfy their constituents and the need for the politicians to raise a large amount of money to get reelected.
What do those dynamics do to the decisions they make?
They raise money from the financial sector and many other sectors, and they have to at least be friendly with people in the financial sector. So right now the mobs are out, the torches are burning, the pitchforks are out, and the Congress is trying to be seen to be doing something.
Henny, you want to back clean up on this?
Thank you. I want to talk about the distinction between regulation and supervision, because there's this sense that we didn't have good rules. In fact, if the regulators had enforced existing rules and exercised effective supervision, the crisis wouldn't nearly have been as bad. So I really agree with Mark, but at the same time, I just want to stress that the buildup in risk in the system, the mispricing of risk, all happened, and the regulators shut a blind eye because it was all off the bank's balance sheets in these special purpose vehicles. And we'd been through all this with Enron just a few years before. So I'm extremely skeptical that even if we get the rules right, will we get the enforcers right?
Alan, you want to make that distinction between regulation and supervision?
Well, I do want to say something about the supervision. People seem to forget how quickly this event came upon us. Up until December of 2006, everything was going along very, very smoothly. Nobody seemed to be aware, and by that I mean nobody in the regulatory world, nobody in the banking world, nobody in the rating agency world seemed to be very aware of the impending problem. And then when the wave hit, it hit so very quickly, people could scarcely react in time.
Marc Rowe, do you think it's possible to address all three issues with the current legislation that's on the table before your Congress?
No. It's even possible that we'll fail on the 2 out of 3 that the authors were hoping for. I'll give you one example. There's a lot of faith now in Congress in if we can get these derivatives instruments traded in a clearinghouse, things will be okay. In that collateral will be required based on the level of risk of the derivatives that are being traded. And what I think is going on is we know we have a problem, and so we've got to really hope that we've got a solution. And the designated solution psychologically has become, for a significant chunk of people in maybe the United States Senate, has been this clearinghouse, without really realizing that the clearinghouse makes things better, but it doesn't make things completely better. There are a lot of things that even went wrong this last time that could go wrong with a clearinghouse. So, for example, what the clearinghouse is supposed to do that's supposed to be magical is when somebody's trading these credit default swap derivative instruments, collateral will be posted, and if something goes seriously wrong, the trades will be honored. The problem is, or there are several problems, but one problem, feeding off of your earlier discussion of Greece, there are credit default swaps written on Greece. So if Greece defaults, somebody has to pay a lot of money. The problem is it's very hard to figure out how these should be collateralized, in that if Greece defaults, the right amount of collateral is 100% of the obligation. But what are the chances that Greece will default? 10%, 5%? Well, so the collateral might be 5% or 10%. The problem is that for a lot of these instruments, they don't trade like wheat, which moves a few pennies every day, and we can always figure out what the right amount of collateral to call for will be. The clearinghouse has a problem in that for a lot of these credit default instruments, there's even a phrase for it, jump to default. Everything looks fine, like things looked in 2006, and then all of a sudden, a lot of things go wrong. And when those lot of things go wrong, we may have moved the risk of the too big to fail AIG or the too big to fail Bear Stearns over to the clearinghouse, but then the clearinghouse is too big to fail.
Okay, let me jump in here for a second, Mark, because
sure.
A reminder to all our guests tonight, we're not on CNBC, this is TVO. We got a general interest audience here, and you threw a few expressions around there, Mark, that I think we need a savvy FT reporter to come in here and explain what, let's start with this, Henny, derivatives. We know they're called derivatives because they derive benefit, but give our audience the sort of Economics 101 definition of what a derivative is.
Well, let me just talk about credit default swaps, because that's the one that everyone is focused on. It's a form of insurance. And if you buy the debt of some company or some country and you're worried you won't get paid back, you can get insurance, just like you can get insurance on the house that you live in. So if it burns down, you get money. You could buy life insurance so that your family is looked after if you die. The trouble with these financial insurance contracts is you may not own the house. You may not be a member of the family who will get the benefits of your death. And that means you have a stake often in something not going right. And that's one of the tricky problems with this kind of insurance.
So it perverts the incentives, so to speak.
Exactly, exactly.
Okay.
If I have a house, I don't want it to burn down. But if somebody who is living at the foot of a volcano in Iceland has that house, you know, it's a different proposition for me.
I hear you, but Marc Levinson, does that instrument, which may have perverse effects, does it still serve a useful function on the capital markets?
Oh, the instrument serves a very useful function on the capital markets.
What is that?
Under some circumstances. It allows investors to hedge risks. The problem is that this instrument can be misused by people who have incentives for a company to go bust. They may actually make money by encouraging the company or the government, in the case of a state or a country, to default on its debt. That's a pretty undesirable outcome. And the other point that's important here, Henny was using the insurance analogy. Well, when you buy an insurance policy from an insurance company, there are regulations that require that insurance company to maintain capital to protect you, to make sure that it'll be able to pay a claim on that policy. A derivative isn't exactly like that. There's not exactly that sort of capital backing it in many cases. And so this is the big regulatory issue, to make sure that these will be paid.
Just so everybody gets a sense about what we're talking about here in terms of dollars, Michael, let's bring up this graphic, if we can, at the bottom of page 4. This is a huge, huge market in the United States, the derivative market. Henny talked about credit default swaps. Here are the derivative dollars. Look at what these major financial institutions are doing. Chase, I mean, north of $70 trillion. Bank of America Corporation, between its bank subsidiaries and its other legal entities, also up around 70. Goldman, Morgan, Citigroup. We are talking massive trillions upon trillions of dollars. And I guess, Alan White, would regulating these institutions shrink the size of those markets and therefore cause problems for those institutions?
Well, it might shrink the market. It depends how you regulate it. The question is, do you want to do this? Those numbers look very grand indeed. Those are not the value or the price of these contracts. That is what they call the gross exposure. And in fact, if you look at that $80 trillion, probably they owe 40 and they are owed 40, so that the net balance is very, very small. If you look at a Canadian bank like the Royal Bank, I don't know the exact numbers, but they have about $500 billion in traditional assets, and they have about $6 trillion in derivatives.
That does not sound balanced.
But those derivatives are long and short positions. And so their actual exposure is very, very small. They manage the risk very, very closely. And
they try to buy and sell in roughly equal amounts. The problem with an AIG is they were selling insurance and they didn't have any hedges on. So if they actually had to pay out, they would be bust.
So Mark Rowe, when you look at all of these numbers, do you think there actually is a way out there for Washington to regulate this so that the kind of absurd or perverse risks that were being taken don't happen anymore?
There are things that could be done. They're probably not going to be done, at least not right away. And partly this may hark back to your earlier program, in that these derivatives trades are very profitable for the banks, and the banks aren't making all that much money elsewhere. They're influential in Washington. and they'd like to keep this derivatives business, partly because people would prefer to trade with Citibank or a large bank that's going to be too big to fail, because they know that the other side will pick up, the trade will be honored, because the United States will never let Citibank fail.
Mm-hmm.
And that's, if we go back to a dilemma instead of a trilemma, that's kind of our dilemma, in that we've got banks that make money on these derivatives. They're influential in Washington. They have some significant function in pushing off risk for the user. But then we've got this entities, or this set of entities, there are about 5 of them, that are just going to be too big to fail if something seriously goes wrong a few years from now.
Okay, this expression keeps coming up, and let's, Henny, let me get you to start off on this and help us understand what's being done about this idea that there are some financial institutions out there that are, quote unquote, too big to fail. What options can Congress implement in order to avoid that concept of an institution being too big to fail?
Well, obviously they can try to break up the banks. They can try to reduce the activities that they have decided are the riskiest for the banks. So that is why you have proposals like the Volcker Rule, which say that banks really shouldn't be able to trade for their own account. Or you have this notion that perhaps banks should spin out the unit out of which they sell this kind of insurance that we refer to by the odd name of credit default swaps. So there are efforts to make the world safer and reduce the risk that we will have to use taxpayers' money to support these institutions. One of the great ironies of the crisis is that you've given too big to fail status to many institutions which arguably shouldn't have it, i.e. a GMAC, and at the same time, you've seen greater concentration. So a JP Morgan is far more powerful today than it was a few years ago. You've seen so many competitors leave the field. You've seen so much merger activity that actually we've seen this great consolidation, and in some ways have made our system even more vulnerable today than it was going into the crisis.
Marc
in
Levinson?
a very counterintuitive and
Yes.
ironic way.
Mark, pick up on that if you would. The Volcker Rule, with the so-called Volcker Rule, which would prohibit using depositors' money for stock market trades. Can you give us the kind of pros and cons of why that would be an advisable policy move?
Well, the Volcker Rule, so-called, is aimed at what's known as proprietary trading, which is banks using money to trade for their own account. There are a lot of reasons to do that, because banks right now trade on behalf of customers. They also trade for themselves. They arguably have an advantage trading for themselves because they can get better prices because the people are trading with know that they're backed by the government. The thing is, this proprietary trading business is a pretty small share of banks' total business. Even if you were to totally do away with it, you'd still have some enormous banks. So that doesn't really address the problem of banks being too big to fail. I wanted to point out here that there are a lot of complexities in regulating banks that people don't understand very well. And one of them comes to the fore in this area. You don't want to regulate so tightly that you drive activity out of the banking sector. And that's an issue in this area. For example, there is legislation that would attempt to keep banks from trading derivatives. Well, if there's an economic need for derivatives, somebody's going to trade them. And if you make it hard for banks to do that, then you're going to encourage companies that perhaps are even less supervised than banks to get into the business. You don't want that. You want the activity to be in the regulated part of the market. So you have to regulate, but you have to regulate in such a way that you don't drive all the business to the unregulated sector.
Alan, now that's an interesting point. How significant would you say the dangers are of doing something like that, whereby then you encourage, I guess, a lot of this activity to go either to foreign companies or to hedge funds, which are less regulated and supervised?
Highly, highly likely.
Highly.
It will not only move to other institutions, it will move to other countries. You can see a capital market developing in China, for instance. This was how London developed as a financial market changes in regulations in the 70s that pushed a lot of business off to London. There's clearly no appetite amongst the legislators to break up the banks. And I think the banks don't want it to be broken up. All of the other provisions that they're putting in place don't seem as though they'll be very likely to be helpful going forward.
Mark, this seems like a complete conundrum here. For every problem that is trying to be solved with some kind of legislative activity, the corresponding downside of taking that move seems more significant than the problem you're trying to resolve in the first place. So what's a poor legislator to do?
This is a problem for legislators. Even too big to fail can be a misnomer. The savings and loan crisis was a crisis of many small institutions who all did the same thing and who disproportionately failed at the same time. So even if we broke up the banks, which just isn't in the cards, we don't really get away from the deep too big to fail problem, in that if we have 5 mini city banks, all of whom do the same thing simultaneously and wreak havoc with financial markets, we've got this group of banks that then becomes too big to fail.
Henny, figure this one out for me. How come Lehman Brothers was not considered too big to fail, but like Bear Stearns, for example, was considered too big to fail? How do they make their decisions here?
In retrospect, many people think that was a great miscalculation by the authorities. Had they let Bear go, Lehman would have gotten the wake-up call. I think in the eyes of other central bankers that I talk to when I travel, the U.S. seems to have been so random, so arbitrary. It was really making things up as it went along. So we save Bear. Indeed, we give shareholders $10 a share of Bear. We wipe out Lehman. We wipe out not only the equity in Washington Mutual, but we wipe out the debt. So one of the things that I think is really important is to come up with some regime that says, this is the playbook. This is when we should intercede. This is when equity gets wiped out. This is when maybe the unsecured debt gets wiped out. But we can't look as if everything we do is so random and so inconsistent and so political.
Marc Levinson, is it possible to write that kind of playbook specifically enough, the way Henny's described it?
In my view, it's absolutely not possible to write a playbook like that. There are no rules. You have, in the midst of a financial crisis, people making decisions in an atmosphere of crisis. Was Lehman too big to fail? The reality is that nobody really knew the answer to that until it failed. And if the regulators had bailed out Lehman, let us say, then they'd be subject to criticism from how many people who said, oh, you should have let it fail, it wouldn't have hurt anyone. You just don't know. I think one of the things that's most troubling to me about a lot of the debate going on in Washington now is the idea that somehow you can put this on autopilot. You just can't put it on autopilot. At the end of the day, people are making decisions in real time about issues on which there's a very, very high degree of uncertainty. They are guessing, and there's just no way around that fact. And you don't want to tie the hands of your regulators. There is a certain interest in Washington in saying, we don't want regulatory discretion. We want to tell the regulators what to do. The reality is you have to have regulatory discretion. That's the only way that you can handle some of these crises.
Henny, I feel I should give you a shot to come back at that. Mark says, forget the playbook, it's just not possible. What do you say?
No, I think I agree with him. To some extent, you have to have discretion. To some extent, you have to have rules. When do you wipe out the unsecured debt? You know, you can't afford to let everything appear so random. And I also think that there's two questions. One is whether to let something go or not. And then the other question is how you let it go. I think one of the lessons of this crisis is that in the middle of a crisis is no time to talk about moral hazard. You know, I think that the authorities, you'd ask me, why did they let Lehman go and save Bear? From their point of view, they had given all kinds of warnings to Lehman Brothers. You've got to raise capital, you've got to sell assets. And people at Lehman were really tone deaf. And one of the interesting things that the Lehman Examiner says is, you know what's strange? All the executives at Lehman had more shares in Lehman than any other firm. So they should have had an incentive to save Lehman. And yet, why didn't they? And it's a really interesting question. And one of the things he raises is, were they so self-obsessed that they just didn't want to raise capital because that would dilute their own shares, which is a very sad question and answer, if true.
Indeed. Alan White, help us with this then. If hate using this expression, but if the bottom line here is you're trying to establish a system that is more transparent and more accountable, and lawmakers are supposed to put in place a regime that will see that happen, what do they do?
I think one thing that may be helpful is, in fact, this clearing corporation.
Explain what that is.
This is a central clearinghouse through which transactions are monitored. It serves two purposes. It helps the banks in one sense, because right now they do post collateral with one another on every transaction. And there's a huge duplication in terms of the posting of collateral. If you go through a clearinghouse, there will be economies in that sense. And the advantage from the regulator's point of view is that through the clearinghouse, they get to see what everybody's position is, because all of the transactions would go through the clearinghouse.
Now, the banks own the clearinghouse?
The banks might own it. It would have to be regulated like a utility. You would have to treat it like an oil pipeline.
Would they own it and run it and be responsible for it?
It would be regulated to the nth degree and not be profit-making. It's a utility.
But it would improve transparency and accountability.
Yes. One of the big problems, if you think back to long-term capital management, when it failed, every financial institution knew their exposure to long-term capital management, but nobody knew the aggregate exposure. And the same thing happened with AIG. A lot of institutions had some sense of the exposure this time, but it was never really clear.
Marc Rowe, what do you think of this idea of a sort of a central clearinghouse which would improve the transparency, the accountability, run by the banks, but supervised to the nth degree?
Clearinghouse is good. It's a step forward. I was mentioning before, in many sectors, this seems to be our designated solution. But the clearinghouse is, at best, going to be a partial solution. And part of it is that sometimes markets move very fast, and things will work nicely for several years, day to day. But when something very fast happens, Alan mentioned long-term capital management, what unanticipated shift in the Russian ruble and long-term capital management run by Nobel Prize winners fails, I'm not as convinced as other people that the clearinghouse will be able to catch that change in the market ahead of the curve, so that they'll be able to insist on more collateral posts and the like. And while it'll be regulated to the nth degree, and this may solve our problem sometimes, we know that regulators make mistakes, and they'll be lobbied by and pressured by bankers who want to put the minimal amount of capital up, because it's very costly to put this capital up. So the clearinghouse is a step in the right direction, but it's a more modest step than a lot of people in Washington think it is.
Marc Levinson, is it also a fact of life that, every time you catch up, the other guy's going to get ahead? The regulators and the supervisors think they've caught up to the latest shenanigans, and then, the financial institutions come up with something else. Is that just a fact of life here?
Well, not only is this a field in which there is a lot of innovation, Steve, but it's also a fact that financial activity can be very sensitive to regulation. Let me just give you an example. I think we're all aware that part of this financial crisis is caused by the great growth that we had in securitization. Why did we have such rapid growth in securitization? Well, one reason, certainly not the only reason, but one reason is that banks had an incentive not to want to hold loans on their books because they had to set aside capital against them, and that was expensive for shareholders. So banks decided that in many cases they were better off simply making the loan, taking a fee for making a loan, and then selling it to somebody else in the form of a security. So you can have these perverse effects, and the banks will pay very close attention to what sort of things are encouraged by the regulation, and they will do those sorts of things.
Okay, 5 minutes to go here, and let's go down this partial list of some of the pressures at play here and then get you to comment on these. And Henny, I'll go to you first on this. In your country right now, we see populist anger. We see historically high rates of public indebtedness outside of the full mobilization for war. We see high rates of joblessness. We see a fairly tepid recovery. You might call it a jobless recovery in some respects right now. Do these pressures, in your view, provide the impetus for financial reform, or do they really argue against significant financial reform?
I think they will lead to financial reform, but whether it will be effective financial reform is a big question mark. So you say we want to make the world safer, therefore the banks have to set aside more capital to back things like the insurance they sell. And the banks turn around and say, if we do that, we can't lend as much. So it is, to use your word, Steve, a conundrum.
Alan White, what do you say on that?
I don't think that the current proposals will achieve a great deal. But I don't think much is needed at this time. We've just gone through a very bad event in which, as a result of the bad event was a macro event, a housing bubble accompanied with all kinds of other macro phenomena, in which the banks lost a huge amount of money and the government had to give them huge amounts of money. And nobody in the banking sector seems to be suffering. And the people are mad and they want something done, but I don't think anything actually needs to be done right now.
Marc Rowe, all of what's going on in your country right now, does it provide the impetus for financial reform or argue more persuasively against it?
It definitely provides the impetus for financial reform. There's a lot of anger out there against Wall Street. The question is whether it'll be channeled into effective financial reform or whether we'll end up just getting a bill so that passed, so that people in Washington say we've done something, even if what we've done doesn't help very much for future stability of the financial system. That's my fears. We'll get something that doesn't help.
You'll get something that doesn't help. Marc Levinson, what do you say on that?
I'm afraid that those of us who've been around this stuff for a while are pretty cynical about Congress's abilities in this area. Many of the problems that we've had in the financial system in the United States were caused by Congress, were caused by past regulatory decisions that were forced by Congress. And the more that Congress is going to try to micromanage the regulatory process, I think the less effective the regulatory process is going to be. At the end of the day, you need effective regulators in place. And that doesn't really depend on the org chart, and that doesn't really depend on a 2,000-page bill. It really depends on the commitment of the people who are in office to fulfill the responsibilities and to regulate.
So despite all of that partial list of things going on right now, it seems that the thing that is screaming loudest are these November elections coming up, because the lawmakers just don't seem to want to be able to. Am I reading this right, Marc Levinson? They just can't do what you think needs doing right now, effective reform? There's just too much in the way?
Some things are going to happen and they'll be good, okay? There will be higher requirements for bank capital. That's probably on balance a pretty good thing. Is there really enough being done here to stabilize the financial system in the way it should be? I don't think so, and I don't really think there's an appetite for it.
Henny, isn't the bottom line here you're all just jealous of our banks here in Canada because they're all so much more solvent, responsibly run than yours?
Absolutely, absolutely. Short answer, absolutely.
I knew we'd find the consensus somewhere on this program tonight.
I don't join that consensus.
You don't join it, eh? You want to take a shot at our banks? Go ahead, Marc.
I'd be happy to take a shot at your banks. It's a lot easier for banks to stay profitable when there aren't very many of them, and it's pretty hard to form a new one. So there's some structural factors in the Canadian banking system that make the Canadian system quite stable, and part of the cost of the stability is paid by the customers of Canadian banks.
Alan is smiling up here. You want a word on that, Alan?
I absolutely agree.
You agree
Our
with
banks are rather protected. We pay more for financial services than Americans do by a wide margin. Now, the positive element is...
Not if you add the cost to the taxpayers of the bailout for many
well, that's
institutions.
a good point. Can't forget that.
But the premium is we have a stable banking system.
Who's got, Marc Rowe, did I see you? You want the last 30 seconds?
Let me echo that. Yeah, sure. What you might have in Canada is a stable banking system because there's less competition. So everybody pays a little bit every day. And in the United States, we have an unstable banking system, and we pay a lot all at once and do better elsewhere.
Okay.
Yeah, that's about it.
That's got to be the lesson. Well, one thing we don't have in this country is a hockey team that ever blew a 3-0 lead in a series. What happened to your Boston Bruins, Marc Rowe? I have no idea.